when I think about tax efficiency, to me, there's three pieces of tax efficiency, and most investors actually only think about one or two of those three pieces. There's income from being invested in mutual funds when companies within the mutual funds have a dividend, right? That income gets distributed through. There's short-term capital gains, and there's also long-term capital gains. And where mutual funds, I think, historically have had this reputation of being less tax efficient is one, because they distribute capital gains at the end of the year down to investors to pay taxes on, versus ETFs essentially allow you to decide when you want to sell the position, and therefore when you want to realize gains, the gains just sit in the vehicle. And then also there's the income component. So if we kind of break those down into some further details, income, first and foremost, is a really important part of tax efficiency, and it's something that we consider across all of our vehicles at Dimensional. Mutual funds, ETFs, SMAs. When you've got companies in these mutual funds that distribute dividends, there's two different types of income that you can get. There's qualified dividend income, which is taxed at a lower tax rate, and then there's non-qualified dividend income, which is taxed at a higher tax rate. And when you look historically at Dimensional's mutual funds, we do a really good job of trying to maximize qualified dividend income in our funds. And so that gives us an advantage relative to other mutual funds that are out there that might be distributing non-qualified income out to you. Therefore, you're paying higher tax rates on them. And therefore, you have less dollars at the end of the day in that after-tax return. So that's one piece. Then the gain piece, as I mentioned, is what I think a lot of investors think of when they think of tax efficiency. For us at Dimensional, as you know, Jeff, because we work primarily with financial professionals, one thing I think that works well for us is we tend to have a little bit more stability in our cash flows, essentially, that come in and out of our portfolios, because your clients work with you and you help them stay in their seat and you help them create a plan, and you help them be disciplined investors when investing gets really tricky, in times like the pandemic or in April of this year. And so how does that actually impact tax efficiency, working with financial advisors? Well, because when you have moments of market volatility, what we find at Dimensional is we maybe have less redemption requests out of our funds in those moments because advisors are doing a really great job. And what that prevents us from having to do is sell securities in a mutual fund, and therefore sell securities that have gains associated with them, and then distribute those gains down to the actual investors. So that function, the way we manage cash flows and turnover in the funds, that alone helps us with the capital gains. And then I think where we're probably going to go next and get a little bit more into is the mechanics of how gains are managed within a portfolio, and then also how they're distributed.